Alright, so you've seen those stock charts, right? All those crazy lines, the colors. It can look like a completely foreign language. Well, today, we're going to be your translator. We're going to break down the essentials of technical analysis so you can actually start to understand what the markets are trying to tell us. So here's the million-dollar question. Can we really predict where the market's going next? Look, nobody has a crystal ball. That's just not how it works. But technical analysis, it gives us a solid framework for making, educated guesses. It's about swapping that fortune-telling vibe for a real strategy based on actual market data. Let's dive in and see how it works. Okay, so here's our game plan. We're going to start with the why behind it all, then get into the language of the charts themselves, candlesticks. From there, we'll talk about market psychology, how to build a trading plan, and finally, what the real key to success is. It's all about building a solid foundation. Alright, section 1. Before we get into all the how-to stuff, the charts and the patterns, it's super important to get the why. What's the core philosophy here? What are the big ideas that this whole thing is built on? So what is technical analysis? Put it this way. Instead of spending hours digging through a company's financial reports and balance sheets, a technical analyst basically says, you know what? Everything I need to know, all the news, all the reports, all the hype is already baked right into the price chart. It's all about reading the market sentiment, not the company's books. And this whole philosophy really rests on 3 core principles. These are like the bedrock of TA. First, the market discounts everything. That just means any news, any economic data, any big event, it's already reflected in the price. The market knows. Second, price moves in trends. Simple physics, right? An object in motion tends to stay in motion. And third, maybe the most important one, history tends to repeat itself. Why? Because markets are driven by people and human psychology. Fear and greed, that stuff doesn't really change. I love this quote because it just nails it. You're not just staring at lines and bars on a screen. What you're really doing is reading a map of collective human emotion. It's psychology just visualized with price data. Okay, so if we're reading a map of human emotion, what's the language? Well, the language is made up of candlesticks. They are the absolute building blocks of any price chart. Think of each and every candlestick as telling a tiny story. A story about the battle between buyers and sellers over a specific period of time. It's pretty simple at its core. A green candle means the buyers won that round. The price ended higher than where it started. A red candle, the sellers took control and pushed the price down. And those little lines sticking out the top and bottom, those are called wicks. They show you the chaos of the battle, the absolute highest price reached and the absolute lowest. It tells you the full story. Now, one candle tells a small story, but when you start stringing them together, that's when things get really interesting. They form patterns. And these patterns can give us huge clues about potential shifts in the market's mood. Let's check out a couple of classic examples. Take a look at this one, the bullish engulfing pattern. It's a classic reversal story. You've got a downtrend. Sellers are clearly in charge. Then after a small red candle, bam, this massive green candle shows up. It completely swallows or engulfs the previous candle. What does that scream? It screams that the buyers just showed up in a huge way and completely overwhelmed the sellers. It's a powerful signal that the tide might be about to turn. And hey, this isn't just some abstract theory from a textbook. Go look at a real-world chart, something like gold for instance. That's XAU-USD. You will literally see these patterns playing out at key turning points. Professional traders are watching for these exact setups to spot potential opportunities. Now, patterns aren't always about dramatic reversals. Sometimes the market just needs to take a breather. That's where you get these triangle patterns. Think of it like a battle reaching a temporary stalemate. Both sides are gathering strength, coiling up like a spring. The shape of that triangle gives us a clue about who's quietly winning the fight and which way the price is likely to explode when that spring finally releases. Okay, so you've spotted a pattern, you're feeling good. Now what? This right here, this is the moment that separates the amateurs from the pros. Because identifying a pattern is one thing, but knowing what to do with it, that's the real game. It's not about being right all the time. It's about having a rock-solid plan. And let's be super clear about something. Technical analysis is a game of probabilities, not certainties. No pattern, no matter how perfect it looks, works 100% of the time. It just doesn't. Your long-term success has less to do with how many times you're right and everything to do with how well you manage your risk when you're wrong. One of the most fundamental rules in risk management is the 2% rule. It's simple. You never, ever risk more than 2% of your entire trading capital on one single trade. Why? Because it keeps you in the game. A single loss or even a few losses in a row won't wipe you out. It gives you the staying power to let your strategy actually work over the long run. So a disciplined trade really has 3 pillars, and you need to have them all figured out before you ever click the buy or sell button. First, your entry. Wait for confirmation, no jumping the gun. Second, your stop loss. This is non-negotiable. It's your safety net. And third, your take profit. Know where you're going to get out and take your winnings. A good rule of thumb is to aim for a risk-to-reward ratio of at least 1 to 2. All right, we've talked about the tools, the candlesticks, and patterns. We've talked about the strategy, your entries, stop loss, and take profit. But there's one final piece of the puzzle, and honestly, it's the most important one of all. It's all about your mindset. You've probably heard this saying a million times. The trend is your friend. It might sound cheesy, but it's famous for a reason. It's always easier to swim with the current than to fight against it. Your number one job as a technical analyst is to figure out which way that current is flowing and trade with it. And really, that's the ultimate takeaway here. Success in trading isn't about being a genius who's right every single time. It's about being disciplined every single time, especially on the days you're wrong. Technical analysis gives you an incredible tool to read the market, but it's discipline that turns that tool into real, sustainable success. So the question is, are you ready to build that discipline?